By way of introduction, even though I'm a market analyst, still involved in trucking. My family has a road train cattle business in Australia. So I went home last month and spent a month on the road just to get a feel for what it was like. And I was glad it was over, I can assure you. It's a hard life. I've done a few million miles as the driver, been an owner-operator, owned trucks, managed fleets. So I know a little bit about what it takes to run a company successfully. I also know a lot about what it's like to run a company unsuccessfully and go out the back door. Right? So I've learnt the hard way about how to do this. There's no magic answers though, but what I want to share with you today is a perspective of where the freight market is right now. And this is like that car trip, right? It's like the kids saying, are we there yet? You know, are we at the bottom? Because this has been a really tough year. When I did this presentation last year, we really didn't know how bad things were going to get. We've been in this trough for the best part of 18 months. It's been a really slow grind. So when I talk freight, I'm not talking gasoline, gravel, sand, ready-mix concrete. I'm talking freight of all kinds over 250 miles. That's what I'm talking about today. That's the freight market. And I'll show you some data around how many carriers have come into the industry, how many have left, what rates look like, what operating costs have looked like in the context of the last 3 freight cycles. Because I think what you need to be able to see is where are we today relative to 2018, 2019, 2020, 21, right? So to get the whole 5 or 6 year snapshot and say, here's where we are today and here's where I think it's going to go. Because we are definitely at the bottom. Rates are starting to come up, both contract and spot. There's been a massive exodus of carriers. It looks like and feels like the market is starting to improve. But it's slow. It's not like any other market we've ever seen. And there's one reason why a lot of carriers haven't left. We as an industry made record profits in 2020 and 2021. There's no question that was one of the most profitable periods in history. And it's allowed a lot of carriers in the freight market to stay in for a longer period of time. So now I'm talking averages and generalities, right? But that's what's happened en masse. Normally when the market turns like it did last year, carriers go out quickly. They didn't this market cycle. They've stayed in for 18 months. They've hung in there. And diesel dropping has helped that cause. So here's what the market looks like. Some good positive news starting to come out now. We're in the seasonality phase where April starts to lift up the market. Shippers have still got pricing power. I'll show you a slide at the end that shows that RFPs that were negotiated late last year for contract freight, that's 85% of the loads hauled, are contract, pre-negotiated rates last year. They're starting to flatten out. So that meant that a rate negotiation last December is coming into a routing guide now for those loads that are used repetitively. Those loads are flattening out. Why is that important? Contract rates were dropping 12 to 15% every month most of last year, but they've flattened out, right? So that's important for most of the freight. It looks like the rates are flattening out. Spot rates, on the other hand, are starting to have flattened out and are starting to move up again, ever so slowly. So we're in this trough phase. And the problem we've got is that there's no real trigger in demand that's going to make suddenly more loads for us to haul. There's nothing in the economy that's sort of saying we're going to suddenly have an influx of more single-family homes and lumber and roofing shingles because interest rates have dropped. Interest rates didn't drop, did they, this week? They held them flat again. And they're now gone from six interest rate cuts in the first 6 months to maybe 3 between now and the end of the year. Because the Federal Reserve is not sure our economy has lost enough heat. If interest rates drop, then people are going to start building homes and investing and building factories, and we will have more freight to haul. But while ever interest rates keep a lid on this, it's going to be hard to say that there will be a significant catalyst that's going to suddenly create more loads for us. It's not going to happen. We can't see that happening in the next 6 months. So I think it's a bit like what we said last year, and that is hold on tight, because this is going to be a pretty rough ride through the rest of this year. I think this trough is going to last a little bit longer than what we hope for. All right, produce season, I'll talk about a little bit about that. And I'll show you I'll jump to the slides, because I think the graphics will show you what I'm trying to describe here about the market. So the first slide I want to talk about is something we showed last year, which is the operating cost, gross profit margin, operating costs and rates per mile for a long-haul owner-operator independent contractor. Now I want you to sort of not focus on $1.81 a mile as the operating costs, because every truck is different and your operating costs will be different, and I don't want to get into an arguing match about what operating costs are, because every truck is different. I've picked an average based on what carriers tell us, what it costs to run my own truck, and what we've been able to figure out from other data sets. About $1.80 a mile, 60 grand in wages, 3,000 a month in finance, 10,000 in insurance. I'm running 100,000 loaded miles at current rates, and I'm running 15,000 miles empty. When you put all of that together, right, for a long haul truck, it averages about $1.81 right now. But I don't want you to focus on the $1.81. I want you to focus on where the green line was at the start of the graph on the far left. Because we started off over here at about $1.70, and then we went through, this is 2018 here, 2018, 2019, 2020, 21, 22, 23, 24. So you can see that green line as we went along. We got into the late 2020 period and our operating costs started to go up. And they got as high as about $2.11 per mile during the worst of the pandemic, and they've come right back down to $1.80 a mile, give or take. So don't focus on the number, just look at how they've gone up and down. Now the blue line is the average dry van line haul rate including fuel. So that's your revenue, 100,000 miles times $2 a mile gives you your revenue, gross revenue, right? Your operating costs, I average at about $1.81, but the bottom line, the red line, is your equivalent gross profit margin in cents per mile. So back in 2018 was a really good year for us, correct? It was a good freight year. It was a strong industrial economy. We had oil price rally, we had changes in the tax code, lots of good things happening. We made on average $24,000 a year in 2018. On average, right? Just as an average. In 2019, what happened? The market really tanked, didn't it? It was non-existent peak season. It was just a slow grind. Rates fell almost all year. We lost the equivalent of $2,000 a year. Now, I'm still paying myself 60 grand a year in wages, right? But my gross profit for that $30,000 in frame, that's where that comes from, right? That gross profit on top of wages. So if we were making 24 grand on average in 2018, we lost 2 grand in 2019, the pandemic hit, and we made as much as $1 a mile gross profit by the end of 2021. So we're making the equivalent of 100 grand a year. Now, not everyone made 100 grand a year, but we went from 24,000 to losing 2 to making 100. So just focus on this massive roller coaster that we've been on, and that red line spiking there is what brought this massive influx of carriers into the industry. The number of for-hire carriers in the long-haul freight sector doubled from when PPP loans ended in July of 2020 to the end of 2021. And they still haven't all left the industry by now. Normally that would have happened well months ago. So what you're seeing here is we made incredible profits in 2021. 2022 started off pretty good. Russia invaded the Ukraine, diesel prices surged, the freight market started to cool, and the next thing, we're on this slide for all of 2022 and well into 2023. And 2023 was a break-even year. So we had 24,000 in 18, we lost 2 in 2019, made 100 in 2021. 2023 ended up being a break-even year. We made 4 grand in the start of the year, we lost 4 grand in the back end of the year. So it was a break-even year. So last year we got by, but we weren't making enough profit to invest in our business to trade up. We weren't getting a return on equity, we're trading down. So we were getting by, but not enough to be viable at these rates that we're at now. So right now, we're losing the equivalent of 8 cents a mile. So if we kept the current run rate going, we'd lose $8,000 this year. So that's where we're at. So don't focus on the numbers specifically, but just focus on where we are relative to each freight market cycle. 2018-19 was a freight cycle. And then we've been in this current freight cycle for quite a while. But that's where we are right now. Why this is important to understand. Normally operating costs trade in a fairly tight band, and I've got those red error bars up at the vertical bars at plus or minus 10 cents a mile to allow for each of your individual operating costs. But here's the thing. I know a lot of carriers paid off a lot of debt when they were making money during the pandemic. And if you paid off your debt, you own your truck and trailer, you can pull 31 cents a mile out of your operating costs. Take 31 cents a mile off $1.81 and you're running for $1.50 and still paying yourself 60 grand a year, wages. For the first time ever, we now have a whole bunch of carriers who can run for 30 cents a mile less, but a whole bunch of carriers who paid triple for a used truck that they need another 30 cents more. So we've got this massive spread, and what it's causing in the market is carriers to be able to run for a lot less than they would have normally. Other carriers need a lot more. Normally that doesn't happen, but that's one of the after effects of the pandemic, is that we had so much profit in our businesses. A lot of carriers did really well, but if you came into this in the late part of that cycle and you paid $110,000 for a 562,000 mile Freightliner out of warranty, right? And we get the calls. You know, I'm trying to finance a truck now that's worth a third of what I'm financing. It's a really tough business and you have to keep moving. So we've now got this split market. So that sets up the next slide, which is how many carriers joined and how many are still here and how many left. Because I think that's the question you're all wondering, is when's this market going to turn and when are the people that are hauling, you know, what we call cheap freight, and it's not cheap freight. Someone laughed. It's not cheap freight, because if you own your own truck and trailer, you can run for $1.50, that might be profitable for you. But if you have to finance $2.10 a mile, right, you need more. So it's all dependent on your own business. So here's the chart. We pull the authority status from the FMCSA, the Federal Motor Carrier Safety Administration. We pull this data daily. The green, the light green, are the reactivations of a motor carrier authority. The dark green are brand new authorities for the first time. And the red are revocations, are carriers that have said, I'm out. So just look at the directionality. From 2014 on the far left, you can see the black line. And then the black line is the spread between the additions and the subtractions. That's all it is. The black line is the spread. And you can see from 2014 until June of 2019, we were adding about 1,000 net new carriers in the interstate sector each month. Now, this is anything from a box truck to a straight truck with a lift gate all the way through to a big heavy haul truck. The FMCSA data doesn't tell us who it is in terms of freight, but it's all the people carrying freight in the interstate sector. So you can see we got to June of 19. Anyone remember what happened in that second quarter of 2019? Remember the news? All the big carriers going bankrupt? That was one of our worst quarters in history in terms of bankruptcies in 2019. That's what that V shape in that black bar is. That's what that bar is right there. And then we continued along to the pandemic. We're still adding capacity because we're always adding capacity in this industry. There's always people coming and going. So this data set here represents about 5% of all of the authorities in the industry. Because 95% of carrier authorities don't change their status each month. Most people stay the same, as they don't come in or out. It's the 5% that moves the needle. It's the 5% that creates more trucks than loads. It's when that 5% starts to leave the industry, we suddenly have more loads than trucks. We're not quite there yet, because that black line is just starting to turn up on the far right. So you can see there in June of 2020, right around when PPP loans ended and rates started to go up, rates went up $1 a mile from the middle of 2020 to the end, and we're bouncing around $3 a mile for dry van spot rates by the end of 2020. And you know how far north of that they went in 2021, right? So that's what that black line is. That's that surge in carriers that came into the industry because rates were so good. Money was falling from the sky. It was very hard not to make money in that period. But that turn down in the black line coincides with when diesel prices surged around the time of the Russian invasion of Ukraine. That's when things started to turn, and we started to see carriers start to exit the industry. And you can see that red line, the red bars start to dip down. They're the carriers leaving the industry. And we went negative, so if we were gaining 1,000 net new carriers each month in the interstate sector from 2014 to 2020, we started to lose carriers in October of 2022. That was the first time we started to go negative. And then we stayed losing carriers at a rate of about 10,000 a month for all of last year and into part of this year. But in this particular month here, in February, you can see here in January we lost 9,718. In February we lost 8,824. So we lost fewer carriers, but we also gained, there were fewer re-entrances. So for the first time, we're actually seeing that black line turn up. Now, we're still losing capacity, but it's not enough to move the needle in terms of more demand, like better rates, because we still have a very soft freight market. Right, so we're still losing capacity, but it's at a very slow rate. And that's what it feels like in the market, because it's highly competitive. You've got a lot more trucks than loads. There's a lot more pressure for people to get those loads in their trucks. But it feels like and looks like from the data perspective that we've gone past the worst of it. That exodus of carriers, the less viable carriers, have worked their way out of the industry. Would have happened quicker had diesel not dropped like it did most of last year. Diesel is still forecast to be around $4 a gallon according to the EIA all of this year. I think it went up to 403 as a national average. Right, so remember, these are averages. I'm just trying to give you a feel for where the market is and what it looks like from a capacity perspective in the spot market in particular. And we know most of these carriers that come in, this 5% of the carriers that come into the market that are new, we know they hit our load board and become spot market players. We know from their DOT numbers. So that's the spot market. It's this 5% that moves the needle for the entire market. It leads the market, right? Now, the next slide is large carriers. So this is the large contract carrier market. It's about 85% of all the loads hauled. So the market is split between contract and spot. Contract, 85% of the loads hauled. Rates are negotiated yearly in advance. They're used over and over and over. If you've got 1,000 loads today, it's the same rate from Atlanta to Phoenix. It's a contract rate, right? The spot market's the other 15% of the loads. That's, roughly. So what the Journal of Commerce Index does, takes from the annual reports of all the large publicly traded companies and it counts the number of trucks they report in their earnings call. And they've done this back to 2006, right? And that's what the blue line is. I just overlaid the red line. I just overlaid DAT's dry van contract rates to give you a sense of how this market is behaving. And I think I start here at 2017, give or take. You can see first quarter of 2018, the number of trucks went up. That's the blue line, started to go up a bit because they were adding capacity because we had a strong freight market in the first half of 2018. Number of trucks dropped off, and then the pandemic hit, and the large carriers couldn't add enough trucks fast enough. And so they added, the number of trucks went up there to about 92% of the index back in 2006. But you can see that red line for 4 straight quarters, the average of the number of trucks of the large public companies has dropped. They've been trying to get rid of trucks as fast as they can. Now, maybe get rid's the wrong word. They may be parking them on the fence, slow rolling, driver hiring. Whatever it is, they are reducing the amount of trucks they've got because contract freight demand has fallen also. So they don't need as many trucks as they did. Now, this is up to the end of fourth quarter of 2023. So I've just shown you the previous chart about how spot market has behaved. This is now the rest of the market. They've been trying to reduce capacity also in the large carrier market. Because whenever you've got more trucks than loads, what happens? Right? Rates rates go down. That's what's been happening for the best part of the year. So I can't wait to see what that red line does for this quarter we're in now, because my instinct tells me it has to flatten. But we won't know that for a little while. So there's where we are with capacity. Any questions on where we are in terms of trucks on the road before I move on? All right. We talked about diesel. I'll just skip past that. The other data point, you can all watch this. This is a really good data point from Chris Visser at JD Power and Associates. It's a free monthly blog, JD Power and Associates. He publishes a report on the used truck prices for all of the different categories, Class 5s through Class 8 used truck prices. Used truck prices are a really good proxy for how healthy the truckload market is. If prices are going up, people are buying trucks, they're getting in. Prices are going down, it tells you there's a lot more trucks on the used truck market. The blue line here are the number of Class 8 trucks on the auction block being sold at auction. And you know why trucks go to an auction? To get sold, right? And you can see from when Russia invaded the Ukraine there's been a steady increase in the number of trucks going to auction. In fact, in December just gone, we had the highest number of trucks sold at auction since June of 20, when the pandemic crashed the market. So it was the most number of trucks, and it was a lot of fleet leasing companies sending their trucks to the auction house. There was also a lot of small operators sending their trucks to the auction houses. So this is a really good proxy for how many carriers are coming in and going out of the industry. Again, it's another data point. This is like a puzzle. Right? No one piece tells you everything, but you've got to put all the pieces together to get the picture. So what I'm trying to do now is give you enough pieces here to get a bit of a picture about where the market's going. So let's talk about demand quickly. Can somebody give me a quick time check? What's your watch say? 7 minutes. Okay. I'm going to be quick as I can here. I could probably go a little bit longer, but the blue line here is our load to truck ratio. It's the number of loads that get posted on a load board. The red line is the rate per mile for dry van. Again, we publish this every Tuesday on our DATIQ show, 10 a.m. Eastern. You can watch it for free, or you can get my blog. It's all the data is going to be there. But the load to truck ratio nationally gives you a really good sense about which direction the market's headed. And you can see on the far right, we're still in this trough period. We're still not seeing any significant improvement in the spot market. The volume of loads on the spot market are almost identical to 2019. And 2019 was what? Not a great year. So if you're thinking about what does this year look like, from our perspective in the data, and we see about a third of the truckload market in terms of the number of loads, we see about a third. It looks very much like 2019 did at the moment. You all should subscribe to Professor Jason Miller at Michigan State University. He produces the Truckload Tonne Mile Index from publicly available data. It's based on 41 freight-generating commodities that we all haul. It's publicly available data. He's built an index that says what's demand look like for our services. And you can see the pandemic where that big V shape is in 2020. That's when demand fell away. On the far right, we're sitting about down 1% in December. It's down about almost 2% compared to this time last year. So if you just think about where demand is, it's less than last year, which is how the freight market feels. It remains very soft. And if you follow him, he has a daily LinkedIn post that will tell you pretty much all you need to know about where the freight market is headed. It's a highly sought after piece of information. He's a very good analyst. But he pushes this out every month, and it's a really good proxy for where demand is for the for-hire carrier market. The other data point to watch, of course, is the American Trucking Association's Truckload Tonnage Index. This is January. I didn't have a chance to put February's in. February was up about 4%, but still down year over year. Right? So, but there was a surge back in the market. Part of that's got to do with the freeze that we had in January. There's a lot less freight volume moved in January because of the cold weather. So there's a bit of a catch-up in the data here. It's another good data point. But again, this is contract freight, not spot market freight. It's contract freight. You can see the seasonality. Produce season, produce, we were off to a pretty slow start. The data as of this morning on the USDA data website, again, publicly available. You can all go to the USDA and look at the dashboard and you look at the number of truckloads of produce in each region, right? And you can look at the rate per mile that everyone's getting, right? Aggregated and averaged. But I've pulled some of this data here. The Pacific Northwest has had a really good produce season so far. California's been way behind the 8 ball. And if you're wondering why your reefer volumes aren't what they normally be, it's a lot of it's got to do with California. Normally this week of the year, California's pushing out about 35% of the national truckload reefer volume. This year it's 8%. So that's enough to move the national needle, right? And that's why you're seeing reefer rates soften even more than they would normally because of the wet weather. They're still trying to catch up. There's still plenty of time for California to catch up. Don't panic. It's just going to happen a lot later and it's going to be compressed, which I think is good for carriers because that produce has got to move really quickly. There may not be as much volume though. That's what you've got to watch. And if there's not as much volume domestically, the volume's going to come from Mexico in particular. All right, so again, you have to watch the McAllen market, Nogales, all of those markets along the southern border. The peak in produce through the Nogales, through the far Texas McAllen market doesn't happen till May, still plenty of time. So produce season still could recover. But we're all changing our buying habits too as consumers. We're not buying as much and we're buying cheaper versions of what we would normally buy. So that's another factor, all right, why produce volumes could be a little bit depressed. I'm just going to wrap up with dry van. I think I won't have time because I want to answer some questions if you've got some. But this is a lot of years of year-over-year rate trends. So this is dry van line haul. So we've stripped fuel out. So this is line haul only. You'd have to add your fuel back in. So this is line haul only. The light blue is this year. You can see the bump in January because of the cold weather. The black line was last year. The green line is 2019. So right now, line haul rates for dry van, excluding fuel, look very much like 2019 did, again, like they did for most of last year. You can see on the blue line was 2018, which at the time we thought was a ridiculous year and you should never compare anything to because it was so abnormal. Turns out it was probably one of the most normal years we've had in the last decade. The red line is 2021, and in February the polar vortex hit, and that's why that red line goes straight up like that. And the market never slowed down from that point on. Rates went up to the right on the red line, and then 2022 happened, and you can see they bounced along until, again, Russia invaded the Ukraine. The market demand started to cool, and that purple line started to come way back down. And we've never really recovered since then. That's how long this market's been in free fall. And then you can see we started off 2023, pretty flat year. 2024 has started off again pretty soft. And it's soft because we've still got a lot of carriers in the market from what happened almost 3 years ago. So these are extraordinary times, because the pandemic created so much upheaval in our market, both on the supply side, a lot of carriers joined, they're still here, and demand changed. The length of haul changed, where freight moves changed. We've now got a lot more warehouses closer to populations, right? We've got a lot more pick-up and delivery work, we've got a lot more liftgate work, a lot more final mile delivery work, right? So a lot of things have changed that won't ever go back to where they were. Where we are in the freight cycles, I've gone back here to show you contract and spot, excluding fuel, back to 2011. We had a freight recession in 2012, 2013, for those that were around and can remember. You can see it was a little bit of a drop there. We had another one in 2015-16. 2016 was a freight recession. But you can see not a lot of volatility, not a lot of movement in the rates until we get to the last 4 years. 2019 was a pretty rough year. You can see the red line, spot rates dropped right down. Pandemic, and then you can see we're back here. We're still sitting well above where we were at the bottom of the previous 3 freight recessions. But what's changed? Our operating costs are about 25 cents a mile higher. Right, so even though rates bottomed out here at $1.60, 20 cents a mile higher than where they were in 2020, Remember the May Day protests in Washington, right? That's that $1.40 a mile. Well, we're still higher than that, but the problem is why it feels like you're being squeezed is because all of your operating costs are through the roof. And that's why it feels like a tight market and you're not getting ahead and you're kind of treading water. Because the market's soft, we've still got too many trucks, our operating costs are high, hard to get trucks in and out of workshops. Like there's kind of like everything's working against you. But the good news is there are some green shoots on the horizon. We get into April, things start to improve seasonally. It's construction season, building season, machinery season, planting season, nursery season, right? Things start to improve. And if enough trucks have left, when demand hits in April, and we get to like Vidalia onion pack date in Georgia, that's the start of produce season. You want to watch that date and then you'll start to see rates come up. That'll tell you what the rest of this year looks like. Because normally from the middle of April when pack date's announced, you'll see reefer rates jump 25 cents a mile to July 4. Now in a bad year, they'll only move up 12 cents. But in a good year, it's a 25 cent lift. So what you want to be watching is what the rates are doing once you get into April. That'll tell you what this market's going to do for the rest of the year. We publish this every Tuesday on our show if you want to watch, or you can subscribe to our product. So questions? We're a little bit over time, but anyone got any questions? So we've got a booth. Help me with the number. 65216. Yep, they're all looking for their iPhones. I think it's 65216. When you walk into the West Wing, you'll see DAT signs there. We've got tons of engineers, marketing folks can answer all your product questions. I'm out in the first row if you want to come over and say g'day. First row in where the show trucks are lined up. All right? Thank you.